Wonder why traders struggle to trade the markets. Why is it so hard to prepare for the next trading day? Is it the amount of information that a trader needs to pay attention to? Some of the common reasons for this problem are looking for certainty in the markets, fascinated by terms like success ratio, hit ratio, desperately trying to predict the future, and actually believing that predicting the future is possible. Trust me friends, this does not work. But there is a solution to this problem, and that is to focus on what is happening in the markets in the present moment, in the now. And the solution is market profile. Market profile is a tool which can be used to monitor the market as it develops in real time, trade by trade. It is not possible to predict the market, but you can respond to it creatively and intelligently using market profile. That way, the trading won't be stressful anymore. So here is the solution I propose. The daily preparation schedule as shared in my market profile course. Let's go through the list one by one. Number 1, study what markets did yesterday. Now yesterday does not mean just the previous trading day, but what it did in the recent past. We have to look at last few days as to what the market was trying to do. Number 2 is tracking the open. Where the markets open in relation to previous day makes all the difference in the world. Let's look at some examples. This is the Bank Nifty chart. I want you to focus your attention on this open. This is the 11th of March. And on the next day, 12th of March. Now, what these both instances tell us is that the markets are opening outside of previous day's range. So you can see that there is a nice gap when it opens, like this was here, and then on the next day. When markets open outside of previous day's range, what it tells us is that the buyers are in control of the markets and they want to push the prices higher. That is why they have rejected prior day's range and they are going to explore new price levels to the upside. The third point in the list is tracking the opening of the markets. So let's look at an example of how after opening what market does gives us some deeper insights into the markets. So just look at this example. This is a nice one. You can see that the markets opened here, then they quickly go down and they try to enter the prior day's range. This was yesterday's high. They tried to enter yesterday's range, but they get rejected equally quickly. This type of opening is called as open test drive, and what it means is that markets tested yesterday's range, they did not find any acceptance there, and that's why they were pushed out of yesterday's range, and that means that the trend is still strong. Buyers are going to explore higher prices. Same here. In this case, we cannot even come close to yesterday's high. We just explore a few ticks lower and then immediately start moving up. All these are signs of strong open and opening times. The fourth point in the list is to observe the early market development. Once again, let's look at some examples. Day in question is this one, that is the 14th of March. And what happens is, once again, this is the prior day's high. This is the open, we open higher. But as you can see, in A period itself, we come back down inside the prior day's range. And one more important thing is, the B period does not move higher. Instead, it again comes back down inside prior day's range. We are getting a lot of acceptance near yesterday's high. And what it tells us is that the buyers may not be very keen on extending the range today. In fact, what they might do is they might end up balancing around this reference, catch their breath, and maybe the next day they will try to push the prices higher. Now this is the classic sequence of balance, imbalance and balance that keeps happening in the markets all the time. So first we had this big imbalance. Now we are looking at a bigger balance, and probably once it is done, and as it was proved on the 15th, we again got an imbalance. So this is the kind of development that keeps going on in the markets, and what the day is going to develop like, the signs are revealed early on in the day. This whole inability of the markets to move away from yesterday's high told us that they might actually end up moving sideways. Okay, so this is the 15th, and what you can see here is that even though the open was inside yesterday's range, markets did not spend any time wasting near yesterday's range. It drove out of that, and then it just basically kept going on up and up in the rest of the day. So this is how open type, opening type and early market development can tell us what the day type is going to be, what the traders are trying to do in the markets. The fifth point is to find a core principle that is at play in the markets. Now I have shared 5 core principles and 3 smart money objectives in my market profile course. These core principles help you apply auction market theory principles to the real time market development. They are extremely helpful and they can help you make sense of the most confusing market action at any given point in time. You have to find the correct core principle that is in play at any given point in the markets. And once you have figured out all the 5 things, what you are going to do then is to figure out what the smart money is trying to do. As I said, I have shared 3 smart money objectives. The smart money is trying to do either of those 3 things in the markets at any given point in time. So the first 5 points will help you figure out what the smart money is trying to do. Now once you figure out what the smart money is trying to do, what is left for you is to match your trade timing to them. So let's see how we can do that. Once you are sure what the smart money is trying to do, next step is to prepare a list of expected and unexpected behaviors. Let's say the market gaps up, right? The trend is up. The expected behavior is obviously for the buyers to explore higher, to seek higher prices. But at the same time, the unexpected behavior is for the buyers to just move sideways in a narrow range or just immediately reverse and come back inside yesterday's range, right? So you need to be prepared with both the circumstances. Just focusing on one expected behavior will leave you exposed to when the markets try to do something else. And the markets will do what they want to do. They are not going to do what you want them to do, right? So you need to be prepared with multiple outcomes, multiple scenarios, so that whatever is playing in the markets, you can use your preparation as a benchmark and take appropriate action. Once you have those expected and unexpected behaviors marked on the chart or inside your mind, what you have to do is then to wait patiently for a low risk trading opportunity. That is where order flow charts, VSA charts or some price action patterns come in really handy. What I do is once I find a good trade idea from the market profile charts, I then move on to the order flow charts and track the market development closely near important references. So let's say market profile has given me some reference where I can expect the buyers to come in. What I would do is I would then move on to the order flow chart or VSA chart, and then I will look for some good trade setups, maybe a delta divergence, maybe trap buyers or sellers based on the context, to enter my position at the best possible price where the risk is the least. Make sense? So that was a step number 8. And the last step is just to repeat from step number 4 to step number 8 multiple times throughout the day until you find a good trading opportunity and you can find a good place to enter by looking at order flow or VSA charts where the risk is minimum. That makes so much sense, doesn't it? One trap I fell into time and again when I was just becoming good with market profile is to fall into my old habits. I tried looking for trade setups, predicting day types and using, or relying on some arcane rules pertaining to market profile like the 80% rule or the often misinterpreted failed auction. I tried to superimpose my old habits onto market profile. And I realized that there was something missing in my way of analysis. But at the same time, I also realized that there was a lot of potential in this particular tool. So what I did was I took a leap of faith. I said I'll have to leave whatever I have learned so far. I have to trust myself. I have to trust market profile and then start using only market profile for a while. So I left everything. I used to rely on Elliott wave, technical analysis, price action, indicators, so many things. but I just left them all and I just focused on market profile for a while. I took that leap off, and the reason I did it was because time and tide waits for none. See, you can always recover the lost money in the markets, or the money you can spend on learning how to trade, on courses, on seminars, on books. You can recover all that money, but the time that is lost, you cannot recover it at all. So you have to be very, very careful with what you do with your time. The money can come back, but time does not. So I say you stop wasting time, because the time to commit is right now. Don't take half measures. If you want your dreams to come true, just take that leap. Once you start figuring out markets using market profile, you will feel that you have discovered a superpower. You will start feeling invincible, and that is precisely when traders tend to fall into their old habits. Have any one of you felt like this? If you have, let me know of your experience. Just type it in the comments window. Let me know how you started doing well but then again fell back into your old habits. But there is no need to worry, as the recovery in these stages is often swift. Because once you taste success with market profile, you will never want to go back to your old habits again. So let's recount the process once more. Step number 1 is you start with looking at what happened yesterday or in the recent past. Step number 2 is you track the open, where the market is opening in relation to previous day. Step number 3 is you track the opening. Step number 4 is you go for analyzing what the early market development is in relation to prior day, in relation to open, in relation to the opening. Step number 5 is to find out which core principle is at play. Step number 6 is to figure out, based on the top 5 steps, what the smart money is trying to do at this particular moment in time. Step number 7 is to prepare a set of expected and unexpected behaviors which you can use as benchmark when you start trading. Step number 8 is to look for a low risk entry point into the markets, and for that purpose you can use order flow charts or VSA charts. And step number 9 is to just keep repeating step 4 to step 8 multiple times in the course of the day till you find good trade opportunities. So if you learn and use market profile in your trading, you can go from focusing on certainty, desperation to know the future, relying on terms like success ratio and hit ratio, and trying to predict the future, to monitoring the markets in the present, right in the now, understand and track important factors like the opening, recent market development and the like, and knowing what the smart money is trying to do at any given point in time, and then trying to match your trade timing with them. Trust me guys, this can change your trading forever. Like this video? Then give me a thumbs up. Also, you can tell me what topic I should make my next video on. Do subscribe to my channel and don't forget to ring the bell icon for the latest at Dean Market Profile. See you in the next video.